All right, so good morning, everybody. Want to welcome everybody to the Mr. Top Step Bootcamp, and today's presentation by myself, David Dubay, over at Polaris Trading Group. Our discussion today will be on the 3-day cycle, and it's also known as the Taylor trading technique. Some of you may be familiar with it. If you're not, we will get you initiated with that today. Before we get going, again, just want to highlight the normal industry disclaimers. Polaris Trading Group, we offer educational services and products on a subscription basis, and the NFA compliance, as we all know, trading in futures and options is speculative in nature and involves substantial risk. Of course, past performance is not indicative of future results. So that's all boilerplate stuff. Want to get right into the presentation. So for those of you that don't know who I am, again, my name is David Dubay. I am a 30-year veteran, having worked for investment banks and hedge funds, and currently an independent proprietary day trader offering trading education over here at Polaris. My background includes working for the old Shearson Lehman Brothers years back, no longer in existence. United Bank of Switzerland, where I was a market maker in listed in NASDAQ stocks, also trading futures in a variety of derivative products over there. I've also worked for some high-frequency type hedge funds between the years of 2005 through 2008, and since 2008 I have been, that was when the financial crisis hit. I am now working as an independent trader, as many of you are yourselves, and offering trading education. So give you a little quick background of what we do at Polaris and what our trading mission is. All right, again, trading education, and my mission here is four-pronged, primarily to help improve your decision-making skills in trading, offering you techniques and insights, simply to become a better decision maker that will help you improve your trading. Many people out there have bad habits. We try to encourage new empowering trading habits in some of the techniques and things that we use. A lot of people are wondering, how the market reacts in trades and so forth. It's not as mysterious as most people think. It's pretty straightforward once we have, kind of a template and an understanding of how the market participants interact with one another on a variety of different levels. Today we'll discuss one of those ways of demystifying price action and trying to offer you guys some sort of a template, all right, to begin your day with on a day-to-day basis. And the last portion is how to become a more informed trader. Now, that's an important one because a lot of people tend to categorize trading into those professionals and the retail. My viewpoint is, regardless of what type of a trading account size you have, or if you're working for an organization, such as an investment bank or a fund or some sort, I've seen people that trade a lot of money be totally uninformed of what's going on, and that's kind of a dangerous combination. I've also seen traders that are typically categorized as retail, very good traders. So my categorization simply is there are the informed traders and the uninformed traders, and so we want to make sure that we're in the informed group, and that's one of my missions here as well. So that's the four-pronged mission here at Polaris. There's a lot of moving parts in what we do, but we will focus today on the 3-day cycle. So a little bit background about the 3-day cycle is it was originally created by George Douglas Taylor also aka the Taylor trading technique. Back in the 1940s, 1950s, and he was trading, I believe, grains at the time. And what he basically looked for was, it was a short-term method, more of a kind of an intraday type method, to trade inherently, the volatile markets at the time, the choppiness of those markets. And again, we see this on a day-to-day basis, whether you're trading indexes, crude oil, or any of the other instruments. With the high frequency trading as it goes on today, can make the markets pretty volatile and really choppy. But basically, his view was at the time that the markets were driven by the large institutional investor, no different than we have today, i.e. the so-called smart money. I like to call it the informed money rather than the smart money, as we just discussed. But basically the core premise of this was, he was basically taking a collection of all what the institutional funds and investors and so forth, traders, did collectively, and how they drove prices up and down on a day-to-day basis. Basically the market runs from extreme highs to extreme lows. Now, one of the premises that I've learned over the years working for the investment banks is that the markets tend to want to satisfy the range. Now, what exactly does that mean? Well, you have different ways of measuring ranges. The most common way is the average true range, whether you're using a 14-day, a 10-day, a 30-day, whatever it may be. Basically, they're measuring the average ranges over a period of time. And that is a common way, and it's a very satisfying way for the big institutions, because what they're seeking to always want to know is, where is the current price relative, all right, to the upper and lower boundaries of a set period type range. So in doing so, the markets tend to try to find balance, right? Whether you're using market profile techniques, which certainly can be complementary to the 3-day cycle, and a variety of other techniques, whether you're using like Elliott wave, all right, 3 to 5 wave type things. It's all complementary in there. The bottom line is, the individual investors out there, smart money is always trying to push price to find out where balance is and where the extremes of the ranges are. And they're always constantly testing those, as the collective intelligence of sentiment is, going from, bullish sentiment to bearish sentiment. All those type of, collective action focuses on, where can we push price, and where's the lows, where are the highs, and can we violate those lows and violate those highs. All right, and penetrate highs and so forth. And how far can we expand the range if that's the case? All right, what's the nature of the buying and selling underneath the market? So the structure of the 3-day cycle simply goes from what's referred to as a buy day, and to a sell day, to a sell short day. Now, that's a little bit of a misnomer, the way those are labeled, originally labels, and we'll go over the characteristics of each shortly. But simply, I label them cycle day 1, 2, and 3 for easy reference. Now, in the chart to the right there, this kind of generalizes the pattern here. What it simply does is we're looking to establish a low on cycle day 1. That's the starting number 1. And then what the institutional accounts are looking to do, again, they probe for the lows. They're probing where the last seller is sold, where the buyers are stepping in. All right. Again, that could be measurements based upon a variety of factors, as I just previously mentioned. But in either case, they're looking to probe for a low point, from which to force out the weak sellers and establish long positions. Once they're able to do that, then of course their goal is to move their positions higher, right? No different than anybody out there, and to push it higher so they can make sales, right? And how far can they push it is going to be determined on the core supply demand equation, and how far that they with the average range on certain days. And again, there's calculations that we have that we can measure that. But again, so what we're trying to do through this context as we speak today about the 3-day cycle is, as what Taylor did, he was viewing the big institutional players. How can he position himself, since he was a small player, as many of us are as well? How can we position ourselves alongside those bigger players that certainly can move the markets? And that's how we're going to profit. We want to stay in alignment with them, in sync with them, so we can profit. Right? Again, it's a simple concept, though at times difficult to implement. But what we need is some sort of a guidepost or a template to use to make some inferences or assumptions about where the markets may go. Are they extended, or what I refer to as has it gone to an extreme? And what happens at those extremes? Is there a reversal or an acceptance? So many of you using the concept of market profile understand the terminology about acceptance or rejection. Again, similar in concept here as well. All right, so that's the core structure and the premise of the 3-day cycle. Now let's just give you a little bit further background about what the intent is of the big institutional people. So number one, you have the high and low of prior day ranges. So every day those are benchmarks. You have the opening price, of course, is a benchmark. What the 3-day cycle strategies in the smart money want to try to do is, number one, they want to try to force what's called a violation of the previous day's lows. So again, they're always trying to expand that range to some degree, and if they're successful at doing so, they're able to create some sort of a selling panic. And effectively, what they're trying to do is weed out the weak holders. Now, when years back when I was a market maker, and again, I was kind of an active participant in a lot of this stuff. So the 3-day cycle is somewhat near and dear to me. Over my career, I learned about the 3-day cycle long time ago, and it was actually something that we were just kind of an active participant in without actually really realizing it at the time. But as I became more knowledgeable, over the years about the 3-day cycle, it was apparent that these activities repeat themselves over and over again. And so with the repetitive nature of this cycle can give us some insight about what potentially may happen. So force a violation of the prior day's low, or we want to force what's called a penetration of the previous day's high. All right, basically, in order to sell lower purchased either shares of stocks or contracts, certainly at higher levels. All right, we'll see some graphics about that in a minute. So simply the basic concepts and assumptions of a 3-day cycle is that the end of a cycle offers the greatest opportunity. So whether it's the end of the 3-day on cycle day 3 and prices have pushed to some extremes, it's going to be at those turning points that will offer the best reward risk ratios on an intraday swing type basis. Now, this is not a tick trading methodology or strategy in any ways. This is really more of a intraday broader picture where we're looking for larger moves in terms of swings, all right, from extreme highs and lows, and that takes its time over a course of a period of days. And then at the excess, right, where those extremes marks the end of one cycle, and it's again the beginning of the next. So those are the core assumptions and concepts of the cycle. All right. Now going further, getting a little bit deeper into the violation penetration aspects. All right. So if you want to read along here, but simply the market has a tendency to exceed the prior day's low or high. Right. Again, the market institutional folks trying to expand that range. Again, weed out the weak holders. carries some residual momentum from the previous day's action. So for instance, today, all right, market closed strong and high in yesterday's range following the Fed announcements. And then we have residual buying that has pushed prices to some extremes today. And again, we're going to take a closer look. I'll show you examples of our today's action as well. And again, that results in a violation of penetration. And then how far the price moves beyond the prior day ranges can actually be mathematically calculated based upon historical observations. And we'll show you how that is conducted as well. So it's not just a matter of understanding that the price can, penetrate the prior high, but how far on average, all right, on a particular day, cycle day 1, 2, or 3, how far on average, can we expect prices to move based upon historical observation, and what have been the extreme observations been? So we can, again, kind of, calculate our risk-reward opportunities, all right, and potentially where those turning points result in, all right? So if the market closes, one of the aspects is if the market closes low in its range, right, the low of the day is a key reference for the next day. If price closes high in its range, as it did yesterday, right, which was, I believe, 57.50 if I'm not mistaken, the high of the day becomes the key reference point for the next day, right? Again, should be fairly obvious about the high and the lows are always key reference levels. What happens, though, on a retest of that high or low or a breakout of that high or low becomes, where we're going to start making some decisions of, how the market participants are viewing a failure to exceed those reference points, or if they're able to exceed them, do they become new support or new resistance, right? So again, the concept of being accepted or violated comes into play here of those highs and lows. So of course, if the price is rejected, right, again, market participants try to move beyond those high lows and it's rejected from that reference points, then there's opportunities for a reversal position to look for a reversal back into that prior day's range. So this is what obviously that the smart money is always trying to probe for. Can they squeeze the buyers? Can they squeeze the shorts? All right, how far can they squeeze them? Again, it's always going to be referenced against those particular price points. So again, going further in the next slide, again, they're probing for a secure low. This is what we always speak about, especially on cycle day 1. After the completion of a prior cycle, they're looking to probe to see where the next low is. And they want to make sure that there's a secure low in place from which to effectuate the next phase of the cycle. And again, we have some graphics coming up in a couple minutes here on the slides. So the main principle on cycle day 1, basically, which is usually the beginning day of the cycle, is there, though it's called the buy day, all right, and as I said earlier, it's a little bit of a misnomer. A buy day does not necessarily mean that we're buying all on that day. It's not every opportunity we're going to buy. As a matter of fact, to the opposite, a lot of times cycle day 1 tends to have selling occur on it throughout the course of the session. So the idea is there, once that last day of the cycle day 3 is complete, all right, you have those folks that have sold prior longs up into that level and then begin to establish short positions. So what they want to continue to do on cycle day 1, all right, in an ideal cycle, would be to force sellers to unload below the low of cycle day 3. And again, forcing that violation. And that tends to kind of get the ball rolling, right? And in doing so, prices can decline, and we have what's called an average decline value, all right, on cycle day 1. And again, we'll show you that in terms of some of the charts that we have, and we have indicators that we'll display on our charts that will do that. Now, each and every day, what we put out, and I sent out a copy to everybody in the boot camp room this morning, a copy of our daily trade strategy report. And let me just show that, bring that into view here. Hopefully you guys will be able to see it. Okay, this is an email that we send out to our members and our subscribers each day. And again, we just highlight generally the market's trend at the time, our daily economic calendar, and then in terms of what I write freehand each and every day, I write a little bit of a comment about what happened the day before, and then the current day cycle. So today is cycle day 2. So what I wrote today, this morning, for our members and our subscribers are the upside momentum remains intact, all right, but may fade early. Well, it hasn't, so I'm not 100% correct on that. The first marker of support would be the 5150s. We have not seen that since we're above the prior day's high, and the upside projections today currently measure 2166.50. I believe the last sale right now, as we're speaking, is 2166.50. So the upside projections for today have been satisfied based upon a penetration of the prior session's high. Okay, so I have a high of day range projection down here. We have range projections and key levels. That shows the average 10-day average true range. So we have a potential to push as high as 80s, but really the upside projection based upon the cycle day today, all right, is 2166.50. All right, we have currently satisfied that. I think we hit 72s also. And then a little bit further down, I just simply highlight a couple scenarios. Scenario 1 is always a bullish scenario. So what I said here this morning, if the price holds above the prior high at 57.50, then the initial upside objective is 62.50, followed by 66.50 stat X zone. That's what's called the statistical extreme zone. So again, that upside objective has been satisfied to this at this point. On the bullish side, on the bearish side, that would be scenario 2, would be the first sign of weakness, and again, would be a reversal below the 57.50. Remember I spoke about that the key reference highs or lows. Every day we need to know what those are, right? Pretty straightforward. But also we need to know, was that high or low created first in the session, or was it created last in the session? All right. So for instance, yesterday the high of the session at 57.50 occurred last or later in the session. So as a result, there is residual momentum, all right, that has been built up for the next day. All right, and so as we saw today, we had a gap higher that held, and then as such, the momentum continued on to reach cycle targets. Now again, we have a spreadsheet that is able to determine, what the potential for those cycle targets are, and again, I'll show you that in a second. And then lastly, there's a little click here button, and in doing so, it brings you to a let me just bring that into view. All right, I attach a chart that's part of the trade strategy, and again, this outlines the potential for where the maximum penetration level is here, as I highlighted here today for our folks, 2166.50. All right. Again, all this is done, early in the morning, but these levels, by the way, that are all projected on this particular chart, are available to our members and subscribers to the 3-day cycle at the close of business yesterday. So all this is available to everybody in advance. That helps them prepare. Now, keep one thing in mind about whether you're dealing with cycles or profiling, Elliott wave, all right, any of the cycle analysis that people do. Keep one thing in mind, at least from my perspective anyways, they're not predictive. A lot of people want to try to predict where the market's going. Professionals do not predict where the market's going. Now, certainly they have an opinion of where the market, may go, so there's probably some inherent predictions in there. But the idea is not so much predicting where the market's going, but establishing your positions, whether you're an intraday trader or a swing trader, based upon, risk assessment, and using, cycle analysis in any degree is a way of, again, you want to establish yourself on the correct portion of the cycle, and there are projections in terms of where the cycle may move to, and in this case today, the upside projection for cycle day 2 was 66.50, so that has been achieved. But being able to position yourself early in the session, if you're an intraday trader, to stay in alignment with that current swing cycle is imperative, right? So it's not about prediction of where market's going to go on a one day, but rather establishing a low risk with a high reward potential. Okay, and again, everything is potential, so we need to actively manage what we do on a day-to-day basis. A 3-day cycle or an Elliott wave or a profile, or all those type of ways of analyzing the market offer a perspective of where prices may go, right? And using some mathematical computations to identify those levels in advance. So again, it helps prepare ourselves on a day-to-day basis. So what we do there with our daily trade strategy email is simply prepare everybody for what may happen on that particular day. All right. So so we're going back to cycle day 1 here. We're into the each day cycle now. So unless until price reaches the cycle day 1 low. Okay, so remember, on cycle day 1, there's generally a decline, generally speaking. There are other days, there are exceptions to every cycle. But generally, we're looking for some weakness. So short selling, all right, may be considered until price reaches the potential for what's called the average decline. Once it reaches those lows, all right, what the institutional people do, they'll start covering their shorts. All right, and they'll look to start beginning to establish long positions. So the idea on cycle day 1, even though it says it's a buy day, what they're looking to do, the objective is to buy as low as they possibly can, all right, on that particular day and establish positions. Okay, so that's the objective on cycle day 2. Now, once that is accomplished, all right, and here's a graphic of it, by the way. All right, so picture speaks 1,000 words, right? So from the cycle day 3 high up here in the top left, all right, so bubble number 1 here, the decline begins from the cycle day 3 high. Smart money basically begins to establish short positions. Out of their longs, begin to establish shorts. All right, the next day, what they're looking to do, all right, is violate the cycle day 3 or prior day's low, which forces some long liquidation, right? Squeeze out some of those long weak holders and push price as low as they possibly can, using the long selling liquidation as some energy, ammunition, right, to push as low as they possibly can and see if they can reach that average decline level, right, which again, looking for that, creating a cycle day 1 low. And again, it's going to be important whether or not they're able to establish this early in the day or if the low occurs, later in the day. All right. So once they get that low put in place, all right, again, the objective there is to begin to cover all their prior shorts from the prior day, all right, and begin to establish new long positions. Now, again, it doesn't happen in one 60-minute bar or anything like that. There's a period of kind of the backing and filling that goes on throughout the course of the session that this happens. But again, this is a general template of the cycle. There's obviously variations to it, throughout each and every day. News items, certainly that can affect the normal aspect of the cycle. But we are looking at a normal period on cycle day 1. Now, once those lows are established, all right, new money. All right, the new cycle rally can begin. So that transitions us into the next day, cycle day 2, all right, and we'll talk about that now on cycle day 2. So now on cycle day 2, all right, now remember where we were on the cycle day 1. They forced some violations, pushing it to its low. Now the objective now becomes trade price higher, all right, in order to clean out the rest of the sellers. And then a lot of times what happens on cycle day 2, there's some backing and filling. A lot of times prices will come back down and retest the cycle day 1 low for security. All right, and again, that's a natural process. At other times, as this graphic depicts, we didn't get much of a decline. Looks like the sellers were sold out there, and the buyers continued simply to absorb whatever residual selling was. So cycle day 2 basically tends to be a choppy type day, all right, after a particular move. Now, we are on cycle day 2 today live. We don't have the type of backing and filling, but we actually have we've reached the cycle day 2 maximum targets. So having reached those targets today, as we stand live here today on Thursday, a lot of the longs that established themselves over the past day or so, I'm sure we'll be looking to begin to sell and take profits on some of those lower longs. So again, cycle day 2 tends to be backing and filling. They'll take some profits, as it mentions here, right, near the projected range. So the projected range today is 66.50, and that's where we are. So up at these areas would not be wise to establish new long positions. All right, maybe on an intraday scalping basis only, but that's pretty much it. All right, so that brings us cycle day 2. All right, now going into cycle day 3, again, kind of continuing the process. At the beginning of the next day, what is going to be important, of course, is where the prior day's high is. All right, and if price closed high in its range. And so on cycle day 3, now keep in mind, on cycle day 2, remember that the smart money is out there, liquidating some of their prior longs. All right, they may try to hold it up a little bit in order to continue to liquidate their longs, but at some point, if it's a normal cycle, the next, into the next day, they're going to look to exit the balance of their longs or reestablish new shorts for the following day. Now, what's going to be determinant of that is on cycle day 3, the next day, are they going to be able to penetrate that prior high on cycle day 2? A failure of that, where the bubble number 1 here shows, all right, would then indicate that the buyers are no longer dominant, that pushed it up the following day, the prior day. They're no longer dominant, and the big smart money uses that as a signal to bail out of any of their existing longs and or establish brand new shorts, again, against that high. All right, so then once they're established there, again, the cycle kind of begins the same way. They want to force a violation below the cycle day 2's low. If they can't force a penetration above the cycle day 2's high to even expand the range further, all right, they'll take that as a sign of weakness, and then they'll, again, establishing positions and then look to force the cycle day 2 low. That kind of sets the whole cycle in motion. Now, what I'm showing you guys here is really kind of a perfect cycle. All right, and it acts as a template for us, and many times the cycles really play out quite closely to this. Now, there are other cycle analysis. There's some people use a 2 to a 4 day cycle. Some use a 5 or a 7 day cycle. It doesn't really matter what cycle you use. All right, if as long as the cycle that you are using is repetitive. I simply have found the nature of the 3-day cycle very complementary to other analyses, right, between Elliott and profiling and so forth, and it tends to keep us in rhythm with what the market is doing. Now, Another item that I use as an indicator, and it's located here, you've seen it on the chart here, this magenta zone. This is what's called, everybody uses a central pivot, right? You got the daily pivot. We certainly use a daily pivot as well, but I also use a 3-day central pivot zone. Now the 3-day central pivot zone that I use is a combination of a 3-day rolling pivot, central pivot point, as well as a 3-day rolling midpoint of the session, or the median point of the session. So a combination of that creates our 3-day central pivot zone. I learned this particular very powerful indicator years back when I was a market maker. One of the big investment firms showed me to pay attention to the 3-day central pivot zone, and it really acts as a very good support or resistance barrier quite often structurally. A lot of people use moving averages, but it's really best to use pivot type zones. They tend to be much more accurate. And a 3-day central pivot, rolling central pivot zone, I know a few other people within the Mr. Top Step community also use the 3-day central pivot. So it is a very, it's an important type zone to be cognizant of if you've never have been. Very easy to calculate. All right. Some final comments here in observation generally about the 3-day cycle. All right, so generally, things you want to remember about the 3-day cycle. It's basically a cycle from which the institutional community tries to push ranges. Yeah, the high-low close divided by 3 is the pivot there, exactly. They tend to want to satisfy the ranges, and they want to try to extend. All right, well, it's a 3-day rolling. All right, and once you have a 3-day rolling, it just kind of continues. It's just like a moving average, but it's a moving pivot, average pivot, 3-day average pivot. So on the 3-day cycle, all right, the cycle day 3 less the cycle day 1 low is the calculation of the range. So some of the statistics that we've built up over the years now. By the way, the statistics that we have on our 3-day cycle. Our base year began on the calculations here. It was back in 2008, and so we have raw data going back on a day-to-day basis from 2008. But basically, we use a 20 period rolling average of the cycle, and that's and with that, the odds show that there's 84% chance of a positive 3-day cycle rally. Now, what does a 3-day positive cycle rally entail? Okay, so once you have a cycle day 1 low in place, all right, the odds are favorable, 84%, from the cycle day 1 low to a cycle day 3 high. All right, there's a positive skew that even in a bearish type environment, odds are very high that we're going to generate a 3-day type rally. All right, so again, it's measured from the cycle day 1 low to the high and vice versa. So if on cycle, so what constitutes a positive 3-day rally? Right, becomes the next question. So if on cycle day 2 price closes on the highs, all right, we would expect a test of these highs. Whether or not there's a penetration of those highs and expansion, such as we're getting today. All right. Again, there's some probabilities there, but if these highs are tested and they fail, all right, shorts can be considered upon the rejection or failure of the test of the high. All right. So that's one of the bases of. And then if price closes low on this on cycle day 2, okay, but it is still above the cycle day 1's low, that constitutes a positive 3-day cycle. So in other words, kind of to give it a little bit brief, what you basically want to do is once the cycle day 1 low is established, all right, on cycle day 2 into cycle day 3, you want to stay above that cycle day 1 low. But if there is a violation of the cycle day 1 low, and at times there are on cycle day 2 and on cycle day 3, we want to make sure that price gets back above that cycle day 1 low. All right, on cycle day 3. On the opening of cycle day 3, if that opening is above the cycle day 1 low, then it constitutes a positive 3-day cycle. It can be a little confusing, but with some time and understanding and you know, working with the 3-day cycle, it actually becomes fairly intuitive. All right. So these are just some of what constitutes a cycle day 3 rally. So basically, the bottom line here, guys, is you know, on the 3-day cycle pattern, all right, it's been utilized over years by a lot of big mutual funds and hedge funds. So this is something that's very popular amongst that community. There is one particular market wizard in the original Jack Swagger's book that utilizes the 3-day cycle. All right, I won't mention their name, but there are some market wizards that use it as well. And again, these smart money that manages, you know, millions and trillions of type dollars, I mean, their collective actions is what makes the markets move, whether you're using Elliott wave, profile, 3-day cycle, 5-day cycles, whatever it is. All right, the idea simply remains how they act collectively, all right, as a group, determines, you know, where prices are going to, you know, move, and then how far those prices move can be based upon historical observation and calculation, can be extrapolated and projected, not predicted, but rather projected, of where prices may go, all right, and allow us smaller type traders, right, to position ourselves in alignment with this cycle. Now, there's a lot of ways to play it. So if you're using futures, you're an intraday trader. I have a number of customers that use options, all right, on a particular, you know, to play the cycle. That's a great way to play it, especially if you're at extremes. Great way to limit your risk for potential and you know, carry that leverage. If you don't, you know, have the wherewithal to, you know, or the temperament to hold a futures position, you know, overnight, because again, this is a 3-day kind of rolling cycle. So options is a great way to utilize the potential of the cycle activity. All right. So basically, we're always looking as what, you know, Taylor observed, all right, back in the early days when he started uncovering these type of repetitive patterns. They're very useful today, very successful in using them today with what we do over at Polaris Trading Group. All right, and you know, we teach you how to understand, you know, what it does. It's kind of like, you know, this demystification of market action. A lot of people sometimes get very, you know, they just don't know, they can't make heads or tails of what's going on. Now, you know, the markets can be very chaotic and they move very quickly, but they do still, even with all the high frequency trading today, they still follow, you know, consistent patterns. And then that's the whole idea when trading. We're trying to you know, uncover repetitive patterns that offer us at least a glimpse, whether it's a snapshot, you know, point in time or something more dynamic. They give us some sort of, you know, edge, right? We're always searching for an edge. So, you know, utilizing a 3-day cycle can give, right, can offer an opportunity, you know, for that type of for an edge. All right. So again, just to continue in, you know, what we have done, we've created. It has been recorded. Yes, this will be recorded. We are recording it. What we've done is we've created what's called an ebook. All right, an electronic book. Basically, what it's taken is, you know, Douglas Taylor's 3-day method. All right, was originally a book method, and some of you, I mean, there's probably still copies out there. Of his 3-day method out there. You can find on Amazon or wherever you maybe eBay or wherever you may be able to find it. It's a very tough book to read, guys. All right, and yes, we'll have this recording on our website, and it'll be available in probably a day or two. But the core premise was that the market was, and he used his words, manipulated in stages which repeat over and over. And what he ended up doing was simply manually recording these, you know, these observations. Well, what we've done is we've taken that book, that method book, all right, that he did manually, and created an ebook, an electronic book. And I'm going to show you that in just a second. All right. So today's electronic version of what we have shows, bear markets or bull markets, that smart money creates a positive 3-day cycle rally 84% of the time. All right, so here's a snapshot, all right, of what we use on a day-to-day basis that we distribute to our subscribers of the 3-day cycle. And again, this is an example back on, I should have actually updated that to today, but I'll show you, I'll actually show you today's here in just a second. Let me open it up. I'll give you a live version of what we're showing today. Okay, so this is today's live version of the ebook, our electronic book. And what it shows, again, we actually did an entire workshop with our members and subscribers on the ebook, so it's a little bit beyond the context for today. But I do want to show you here that line 7 here. Okay, so the possible high for cycle day 2, and now we are on cycle day 2 today, all right, measures up to 2166.58, so we just round that to 50. So 2166.50 is the projected high based upon the average penetration of the cycle day 1 high. All right, so again, going through the cycles, if the cycle day 1 high is penetrated, all right, and holds, then what is the projection for the upside expansion of that? And it gives targets on a day-to-day basis through this spreadsheet of what the potential is. All right, and that, of course, is 2166.58, and I believe on the cash S&P that equates to right now 2174. All right, and it gives some discounting handicaps of the potential for that to occur. So the odds of a rally up here in the top right hand corner, the odds of a rally greater than 10 handles is 84%. For the day, the odds of a rally greater than 20 is a little bit lower, 46%. So I think I know we've hit that high odds of a rally greater than 10 handles today already. All right. Now, this is distributed each and every day in the evening for the next day. So our members and subscribers can plan on checking this out. Now, we have, let me just see if I can pull this chart in from today. Okay, great. I think you should be able to see this chart. So from the spreadsheet, all right, we're able to project these levels automatically. So some of you may not want to sift through the spreadsheet, or actually may want to do it the night before in preparation. But during the day active trading, we project these levels right onto our charts from the spreadsheet. So you can see up here in the top right hand corner, 66.25, 66.50. That was a projected average penetration should price exceed the prior day's high. So once that penetration occurred early this morning or in the overnight, the projection was for at least getting to the 66.50s based upon the cycle average. All right, we did live in our room just before we began. I gave everybody also a projection of the 2172s based upon some other work that we do, some profile work that we do. But today's penetration targets are hit. Now this is it on the S&P. We also project this. We also have spreadsheets for the crude oil sector. All right, the energy sector. So here's crude oil. If you trade heating oil or natty gas, all right, we have projections for that as well. So here on crude oil, all right, again, it's read the same way on cycle day 2. If the cycle day 1 high, which is the prior high, is penetrated and converted, which it shows here it has, what are some of the projections? So the average projection was 46.22. Some of the extreme projections, not quite hit yet, becomes 46.61, 46.78. So those are still potentially outstanding for today to hit. Okay. So that is the ebook, based upon the Taylor method that we use on a day-to-day basis. Okay, and again, we did an entire workshop with our members that explains all the details that's contained in the ebook. All right, so that basically pretty much concludes our presentation here on the 3-day cycle. Hopefully that was informative for you a little bit, to give you a little taste of some of the things that we do use. Now again, once we have an outline of what the cycle may bring for us, then we drill down into our intraday profiles and all the various other tools that are very traditional and people use. All right, so this offers at least a tops-down understanding of how markets kind of move around. So if you're interested in learning more about what we do, all right. Again, I am a contributor to the Mr. Top Step, so I do I actively offer insights in what we're doing on a day-to-day basis here with our education group. But if you are interested, we do offer a 14-day trial to our room. Come take a look at a closer look. If you want to subscribe to the 3-day cycle, we offer a subscription basis there. It's relatively cheap. It's about $50 a month, and you get the spreadsheet and the ability to post it on your charts. Those we use, on the indicator that we have, we use that for TradeStation, Sierra Chart, and NinjaTrader. So we do cover the major platforms that most people seem to use. So come on in, take a free trial. There's the link if you want to click onto it or write it down and put it in your browser. All right. If you have any additional questions or want to talk more about the 3-day cycle itself and how do you get access to the subscription, you can certainly email me, david@PolarisTradingGroup.com. Not Thinkorswim. The only 3 major platforms that the indicator is useful on right now is we have it coded up: TradeStation, Sierra Chart, and NinjaTrader. Okay. Now that is, keep one thing in mind. That is for the indicator. All right. That is for this particular chart. Okay. That we use as an overlay. You don't need, in order to get to bring the spreadsheet in. The spreadsheet is delivered to your email each evening. Okay, and that requires no particular platform. The contracts that we have is for the E-minis, the metals, and the oil in the energy sector. So gold, silver, I think platinum is in there. I have a partner on this, Rich Boisvit, who created the ebook, and he sends it out to everybody. The energies, of course, oil, natural gas, heating oil, all inclusive of that particular subscription. All right, you can go on our website. All right, give me, I only got a couple more minutes here. Okay, so if you go onto the website, PolarisTradingGroup.com, and under the subscriptions title, you'll see the 3-day cycle. You can get subscription to our daily trade strategy briefing that is sent out each morning, all right, ahead of time, to prepare our members and our guests and subscribers for the current day and what we're looking at. But you can simply just go in here and you can click on and take a little bit deeper view. We do have a couple videos in there, as I mentioned, that we did some workshops on. So you may want to view that about the ebook. All right, that may be a little bit more informative for you to see if you're more interested in taking it. But again, the spreadsheet is emailed every day, and then the indicator is only for those 3 platforms. All right, but you don't need the indicator to participate in getting the access to the 3-day cycle levels. That's primarily based upon the spreadsheet. Okay, so that, I think, brings us right up to the noontime period. I want to thank everybody for an opportunity, and I want to thank Danny Riley and the folks over at Mr. Top Step. Again, this is my second presentation with you guys, and I really appreciate the opportunity to talk to you guys. I am in the room every day as well, so I appreciate that. So all right, so very nice. And again, come take a free trial if you want, or contact me regarding the 3-day cycle. All right, so I want to thank you, everybody, and enjoy the rest of your day in the presentations over here at the Mr. Top Step Bootcamp. It's real good stuff. It's a great collective intelligence of a lot of smart people, and again, I'm honored to be part of that group. All right, so have a great rest of your day, everybody. We will see everybody at the next go around.